My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today, zooming in from Philadelphia, we have a very experienced real estate syndicator, Percy Nikora and Penn Capital Group. They've been involved in 14 syndications to date. They have a fund. They've been investing in secondary markets. That's kind of their niche, and we're going to find out all about that here today. Welcome to the show. Percy, welcome.
Thank you, Dave. Excited to be here and appreciate the opportunity to share some information with your audience.
Yeah, sounds good. So I did a very brief overview, kind of maybe take us behind the curtain, tell us a little bit more about what Penn Capital does. What's your buy box? What markets
Sure.
are you in? That sort of thing.
Yep, you gave a pretty good summary, but in essence, we are owner-operators of multifamily, and we're vertically integrated, which is, again, just a fancy way of saying we have our own property management division. We also do some construction management. And our buy box, our core focus is multifamily, and we like 150 to 250 units. That's the typical sweet spot, if you will. The markets that we like are ones that tend to fly below the radar. So when we first started, we were in Texas. We were outside of Houston. Saw the prices go up in that market, sold that portfolio, then moved on to Huntsville, Alabama. That was seeing a lot of job growth and population growth. From there, right now, we're focusing on North Carolina, South Carolina. And interestingly enough, we're back to Texas, but in Northwest Texas, which is sort of not on everybody's radar, but it's also seeing some good job growth and population growth. So we just started that raise, and that's our 15th project.
Congratulations.
That we'll be getting. And the market looks really good, and there seems to be quite a lot of interest for that.
So Percy, it sounds like you guys are growing great guns, while at the same time, as of 2025, a lot of other syndicators are kind of on the sidelines, or they've been wiped out, or they're licking their wounds. How has all the recent upheaval and unpleasantness affected you guys?
So the last 2 years has been challenging, right, in this space overall. Now, a lot of it depends on sort of which markets you are in, because it wasn't just the interest rates that were a bit of a headwind or the increase in the interest rates, but it's also record new inventory that was brought out into the market in the last couple of years. Now, some markets obviously have more so of that inventory than others. For example, Huntsville, Alabama, even though the fundamentals are really good and we like that market long term, in the last 18 months or so has seen an excess supply. So what we're doing is we're waiting to have that, if the fundamentals are good, that excess supply will get absorbed. And the projections are by the end of the year, early next year, that excess supply should get absorbed. And then we should start seeing that increase in rental rates again. So our plan is, again, just to operate those properties. It is challenging. It's not easy. But we also believe that we're somewhat towards the bottom, or maybe we've hit the bottom for multifamily. It's only time will tell. But even if we're not at the exact bottom, we're pretty close to the bottom. That's our thesis. And so we've just recently started in the last 6 months or so. We've done 2 acquisitions. We'll be closing another property next week. So, we've done about 3 acquisitions in the last 6 months. And as long as the deal makes sense, and that is key, you still have to find the diamond in the rough, go through a lot of underwriting. But there are some good opportunities out there. So we're buying almost either brand new construction or properties that are bought in built in 23 and 24 at like between a 6.25 and a 6.5 cap rate. We don't think that's going to be available for much longer. So we're starting to, again, if the deal makes sense, we believe we can hold it for a little bit, operate it well, then I think that's the time to buy. So we've recently started to acquire properties again after being on almost a 18 to 2 year hiatus.
Okay. So moving ahead, are there any modifications to the exit strategy, or is it kind of the same as it's always been?
Yeah, good question. So initially, we were doing a lot more, I'll say, workforce housing, heavy value add, the sort of typical go in, update most of the units, leave a little meat on the bones for the next person, etc.
Mhm.
But what we're finding these days is that if you can pick up higher quality assets, like I said, we're buying a
Yeah,
lot of
new ones,
these.
pretty
Yeah,
much new ones.
almost,
Yeah.
yeah. And in fact, the last two deals we bought were brand new construction, straight from the
Wow.
builder. So it wasn't
So
even
it's
lived
not
in.
even filled up yet, just
Well, so
vacant.
yeah, so we've structured it a couple different ways. One, we almost think of it as giving two option prices to the builder. We say, okay, here's the strike price, or we'll buy it at this price if we do the lease up. Or if we want to get agency debt, which requires a 90% plus occupancy, then we'll pay a little bit more, but then they bring it to that 90% occupancy, right? And
Got
we
it.
give a slightly higher price for that. So we've done it both ways, but we almost have a programmatic relationship with a couple of builders now. So as they have the product, they specialize in the build. They've made their profit on the build, and
Mhm.
they're looking to get out of the construction loan. So if they know that there's a buyer on the other side, then they're likely to give you a good deal as well. And
Ah,
that's
that
an
makes
area
sense.
where the fund has helped as well, because what we could do is not just go to the seller and say, we have a good track record with closing, we have good relationships with our lenders, but oh, by the way, here are the commitments in the fund. So it reduces the risk for the seller, right? It's more surety of close. So
Yeah,
that
nice.
so we were on the first couple of deals that we used that tactic on. We were not the highest bidders on the property, but we still got the deal because we could show that and offset the
Interesting.
risk for them.
Oh, very smart. So I interrupt you. I apologize, Percy. How has your exit strategy
Oh,
changed?
so our exit strategy right now is primarily, especially if you're buying brand new construction, it's not so much of a value add, right?
No,
I
no.
would say but you can look at it in terms of how can we still increase the net operating income, which is really what drives the value of the multifamily properties, because you get a multiplier of 17 to 20 times that, right? If you use a
Right.
5 cap rate or a 6 cap rate. So we look at it as, okay, as we buy the property, what are some programs we can put in place that add value to our residents, but will also add value to the overall property? For
Like what?
example,
Okay.
well, the simple ones are valet trash, right? But we do high-speed cable. So we have
Sorry,
partnership
sorry, you said Valley what?
valet trash. So that's where the residents pay a slightly extra price, but they just leave their trash outside their unit, and somebody picks it up and takes it to the dump for them,
Oh, okay.
right? And
So
you'll be
there, so like right beside the door kind of thing,
yeah,
and it gets
exactly.
picked up.
Yep. Yeah,
Okay, interesting.
there's a nice looking container that they have with a little flap, right? So it looks well nice. It's not like a garbage bag outside. So they
So,
put it in that
is
container.
that in like, a typical apartment where
Mhm.
it's just like hallways and
Yep.
all that kind of doesn't get stinky on garbage day?
No, so it's they have to do it within a certain time frame. So there's a
Okay.
time window that they're given. Plus they have these, it has to be tied up properly. There are certain rules they have to
Yeah.
follow.
Yeah.
If they
Yeah.
don't, they get fined.
Okay.
So so, but let's say they follow the rules. So it's all tied up. It's
Well,
sanitary. It's
that's quite a convenient service. That's the
exactly
first
because
time I've
a lot
heard
of
of
people
valet
don't.
trash. Never
Yeah,
heard of that before.
and that's actually a fairly common one. And then we were one of the first in Huntsville, actually the first apartment complex in Huntsville to have a partnership with Google Fiber to provide high-speed fiber to the units. So the residents actually get internet, or whatever it was, a gig internet speed at that time. This is going back a few years ago now. Um, During COVID, right? And during when people wanted to work at home, they get it at a price cheaper than they would be able to acquire it if they went and contracted with Google directly. And obviously,
Okay.
we have a revenue share on the back end, and that goes straight to the bottom line, right? So
Right.
that's adding to our NOI.
Hmm.
Similarly, there are other programs like there's a virtual concierge service. where again, very popular during COVID, but it's still popular. They do yoga classes through like a Zoom-like session. They
Uh,
had wine tastings. They have recipe things, right?
wine
So
tasting
we,
it over Zoom. That'd be interesting.
well, yeah. So they have these different online sort of courses and classes that you can participate in. So it's engaging for the residents. We have package services. So we try to look at it and say what would add value to the residents that they don't mind paying for that
Mhm.
extra convenience. And for us, it's a way to increase the value of the property.
So, with all of those different things, if you don't mind sharing, Percy, how much difference did that make on the bottom line per month per unit? Just to give me an idea, give or take.
It depends on the service that we offer. Like washer dryers are another example where we can
Mhm.
rent the washer dryers to our residents.
Like right,
And
right in their unit.
yeah,
So it's not
and
included. It's a separate
yeah,
fee for the washer
by
dryer.
default they get the what they call the connections, right?
Yeah.
But if they can bring their own, or I think we charge $55 or $65 a month additional for a washer and a dryer.
Mhm.
But in reality, it's a leasing program that we have with another supplier, another vendor who provides that for us, right? So it's not a capex
You're
on
you're paying
our,
you're paying 30 bucks and they're paying
yeah,
65
exactly.
bucks,
That's
and you've
right.
got a profit.
Yep.
Got it.
Mhm. Yep. And they
Nice.
maintain it and all of that
Yeah.
as well.
Smart.
So that's one example. Same thing with, the high-speed internet service. There's, rough anywhere from 35 to $45, gain on that. Um, Cable is another one, right? So there's some complexes that have, if somebody signs up for not just the internet, but a cable package as well, it's a revenue share as well. So all of that can add up, in
Yeah.
terms of what we call other income
Hmm.
that's related to that. It's not directly rent, but it's an add-on to their rent.
Most definitely. So, in your best case scenario, what kind of a difference has that made to the value of a property?
So even if so let's say in general, you can easily get like $100 to $120 in other income, if you will,
In
per
net? Yep.
unit.
Yep.
And let's say it's a 200 unit complex. So even if half of that is going straight to your bottom line, that's a pretty significant.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Increase in the value of the property.
Oh, most definitely. Interesting. Okay, that's very, very smart. What I was going to ask you, Percy. So you guys have property management in house,
Mhm.
yet your portfolio is spread out all over the place, multiple states. How do you manage that?
So we try to create hubs, right? So we've done 7 projects in Huntsville. So we have a hub of our employees in Huntsville. We created another hub in North Carolina last year when we started to purchase properties there. So for the
Hmm.
most part, we try to operate from those hubs, and we try to keep the properties near each other so that we can also benefit by sharing some expenses, etc., or
Hmm.
negotiating better deals with the vendors. Um, sometimes if you're entering a new market, if it's, let's say, in an area that we haven't established a foothold yet, we will partner with another property manager. And we use that, and then we do the asset management. But for the most part, we manage our own properties because nobody keeps as close an eye on the
Yeah,
on the
as you
expenses
do it
as
yourself.
as as
Exactly.
the owners. Yeah.
That makes sense. So yeah, you've got hubs where you've got multiple properties, then you can have a team there.
Yeah.
If you've got a one-off somewhere, then you'll get outside property management and then just manage the managers.
Yeah.
Got it.
That's right.
Now, as we're kind of wrapping this up, Percy, a lot of people are having challenges these days with raising capital. They've had LPs that aren't very pleased with the kind of results they've got recently in some of their deals, or LPs that have just got so spoiled with the go-go days
Right.
of the early 2020s. How is that affecting you guys? And was that part of the reason why you decided to start the fund?
So our fund, no, we started the fund about 2 years ago. And the main purpose for the fund was to offer some diversification, right, to
Mhm.
our investors. Plus, like I said, the one benefit that we sort of found by accident is by to be able to show the commitments in the fund so we can purchase better deals, and that's better for the investors and everybody in the project. But to your point about the challenges with raising capital, I'd say I think maybe, yeah, middle of 2023 and 24 were a little challenging. It did start to get a little better, I'd say, towards the end of last year.
Mhm.
But it was still challenging. I think it's improving a little bit, but again, everybody's experience is going to be a little different based on your track record, the relationships that you have.
Yeah,
Yes, obviously, a lot of investors have been burned. People have lost their money, not with us, but through other deals
other
that they've
syndication.
invested in. I myself have been invested with as an LP in other deals, and some of them have had multiple capital calls. Some of them have lost money, so that does happen, unfortunately. But we've been pretty cautious in how we manage the properties. We try to be pretty open with the investor. So if things are not going well, for example, like I mentioned with the not just the interest rates sort of going through the roof, but with the excess inventory,
Right.
which was not seen up front, we've been giving regular updates to our investors saying, look, this is what's happening. We share third-party reports that are available for that particular market.
Mhm.
And we're pretty, upfront with them, saying, look, this is, it looks like it'll take longer for this market to improve than we had originally projected. So our strategy shifts a little bit. It's more in conservative, we have to be a little more conservative in terms of expenses, et cetera. And it might take a little longer to exit this property versus other markets where they're doing pretty well. We're making actually ahead of projected
Right.
distributions, right? So
Yeah.
it comes down to which market are you in and which specific project, at this day and age. But, knock on wood, we've been raising some capital, and we've raised over 20 million in the last couple of months.
Nice. Nice. Awesome, Percy. Well, hey, thanks very much for sharing what you guys are up to. I love some of your ideas around how to create increase that net operating income, different things to bring into brand new properties to increase their value without jacking up the rent directly. Very, very smart. If people are interested in finding out more about you and Penn Capital, where should they go?
I think a good place to start would be our website, which is Penn Capital Group. That's PENN. That's two N's in it. Capital, CAPITALGROUP.com. And there's a form there you can fill out just to reach out to us, or I think our email address is on there too. But
Yeah.
it's floating around. Feel free to reach out either through the website or directly through email.
Awesome, Percy. Thanks very much for being on the show.
Thank you, Dave. Thanks for the opportunity.
All right, everybody, take care. We will see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.